Good day. I'm excited to be with you. My name is Dr. C. Adam Callery, and I want to first thank the Chicago Minority Supplier Development Council for this opportunity. Welcome to today's session. Fear not, you got this. Bookkeeping best practices, how to keep track of supporting documents. So this particular workshop is part 2 of a 2-part series on bookkeeping. The first one was Stop Avoiding It, Introduction to Bookkeeping. This particular one is going to go deeper into the practice of bookkeeping to help you understand some of the fundamentals of bookkeeping. We can't cover everything you need to know about bookkeeping, but by taking a look at session 1 or part 1 and taking a look at this one, it'll give you a deeper understanding of what the key responsibilities are for bookkeeping. So we're going to open our discussion by reviewing 3 areas. Bookkeeping, fundamental accounting concepts. Fundamental accounting concepts. We also want to review a short business case that I've prepared to help us think through some of these concepts. And then last but not least, we're going to close by looking at some of the common templates that are used. These templates could be used by you. You could essentially copy these templates, put them into an Excel spreadsheet, and help you get started. Or if you hire a professional, they will be using these templates, so you should be at least familiar with them, so it'll help you understand what they're capturing for you and what information is being included on these various templates. So today, as I mentioned, we're going to focus on the core concepts that bookkeepers use in order to move forward in gathering your data, putting that data into a format that they can use, and then also translating that data after it's in that format to the financial statements that we are commonly seeing in business. Income statement, balance sheet, of course, cash flow statement. So let's dive right into it. So what is accounting? The accounting function is responsible for documenting the financial results of a business or not-for-profit. That word function should be familiar to all of you, but it just means it's a business activity, just like marketing, just like operations, just like the human resource function. These are specific activities that are part of running a business. This is important for you who are thinking about starting a startup or you already have a startup in motion. And what you should see is that this accounting activity is part of that business. It's part of the startup, in addition to anything else that's related to the business, your operations, your marketing, your human resources, in this case, your hiring procedures and policies and all that stuff. This is also one of those additional activities. It provides reports, or in this case, accounting provides reports that we call financial statements that show how the various transactions in the business took place or what the results of those transactions were, okay? So accounting is generating reports. Accounting is collecting data. What kind of data? Your financials. Where are those financials coming from? It's coming from the basic or typical transactions that occur in any business. So those transactions have financial impacts. Accounting is trying to measure what those financial impacts are. And once we know what they are, how do they relate to your business and relate to your decision making and relate to your results? So what are the key sub-activities or additional activities that fall under accounting? One is analyzing. We want to be able to look at the results. And once we look at them, we want to be able to determine, understand why we ended up with these results. That's the analyzing. The recording piece, I already mentioned that. We're going to take a look at transactions, and we have to find a way of recording them and put them into some type of financial format. We're going to classify them. And here's the key with accounting. If I told you I spent $100 in my business and left it there, and then I came back to you and said, where did I spend $100? You would not be able to tell me because I did not classify it. I did not give you enough information to help you understand where the money went or even where the money came from. So in this case, I told you I spent $100. If I add this piece, it will help you understand where I spent it. I spent $100 making copies at Kinko's. Okay, so now I know $100 was spent, so I got that. Where was it spent? At Kinko's. Why was it spent? For making copies. So the classification gives me context. It helps me to know there was money that passed through the business. It either came in or the money left the business. The question is, where did it come from? How was it used? Where did it come from? How was it used? And so classifications help me do that. Then last but not least, I need to summarize. So I'm an investor, and it's at the end of the year. You've been operating since January 1st, and now it's Christmas time, and you approach me and you say, I want you, or I'd like to ask you, to invest in my business. And I said, I'll consider it. But you're going to have to show me some financials. You're going to have to show me some information to prove that you're a viable business. Next thing you know, you come walking back into the room, because we're at this big reception, and you come walking back in the room with 14 boxes of papers. And you say, here, this shows that I'm successful, because I got all these pieces of paper. Now, as an investor, I'm not going to look through those papers. I'm not even going to even consider the conversation any further, because it's not my job as an investor to consolidate your information. It is your job to consolidate it or summarize it in such a way that it's easy for me to read, easy for me to understand, so then I can make a decision whether or not I'll do business with you. So that's what accounting helps us to do. It brings all these different pieces of data together, puts it into these nice reports, and then those reports can be shared with investors or bankers. So analyzing, recording, classifying, and summarizing are the tasks, subtasks that take place within accounting. Next, why is it important and a necessary topic for most small business owners? So why is this accounting? Why is accounting an important topic for business owners? It's all because of accountability. Financial records paint a picture of the overall health of your company and helps the owner discern what actions and management decisions to make. Discern, analyze, discern, analyze. It helps me to take a look at these numbers, understand what's happening, and then make a decision. Hopefully the decision I make will help us to move the business forward and, of course, be profitable. It encourages accountability on the part of all employees who contribute to the final statements. So, if I'm tracking, if I'm monitoring my business, and my employees know that I'm tracking and monitoring my business, it helps them be more accountable as well. So, this active monitoring is important to the business. It's important not only for the information that it provides and the insights that it provides, but also it's important to keep everybody moving in the same direction and committed to helping the business be successful. So we mentioned classification is involved when it comes to accounting. Accountants classify the numbers, the dollars, into 5 buckets. One is called assets, other one's called liabilities, other one's called equity, another one's called revenue, another one's called expenses. So let's define each one of these terms for you. Let's start with assets, liabilities, equity, and revenue. So an asset is an item the business owns or control that are acquired to produce products or deliver services. So it's an item that the business owns or control that are acquired to produce products or deliver services. So owning makes a lot of sense. I own something 100% free and clear, meaning I don't have to share this with anyone. I can use this item how I wish. If I have control, I have the same ability, I have the same freedom to use this item as I wish, but I don't necessarily own it. So what do we mean by that? So control would be, an example of control would be if I have a lease on an office space. So I don't own the office space. I don't own the building where the office space is, but I do own control of the space because I've signed a lease. And the lease gives me permission to conduct business in that space. So I have control of the space. Because I have control of the space, I can set it up for my business. Because I can run my business there, I can generate revenue. So that's what control means. And that makes it an asset. That space that I'm in is an asset to the business. Liabilities, item that represents a liability or debt that I owe. In this case, it means that someone has lent me money in most cases, and I have an obligation to pay it back. So a liability is something that I owe to someone else, and I'm obligated to pay it. Equity represents the owner's investment, represents what you put into your startup to get it up and running and get it off the ground. So it represents your wealth, your contribution to the business as the owner. Revenue refers to the dollars earned by the services or the goods that are sold. The key here is that we know that money is always coming into the business, but it's coming in from various sources. It can come in from the bank as a loan. It can come in from an investor as an investment, but it also can come in from the actual operations of the business, and we call that revenue. It is earned, and that's very special because it means that your business is viable, especially if someone's willing to pay you for something. So that means you've earned their trust, and therefore they're willing to pay you. We call that revenue. Our next three: expenses, cash, accounts receivable. Expenses represent the money that is leaving the business. We call it the outlays to produce a product or deliver a service. Best example of that is when we're in a restaurant and we have the wait staff, they come to your table, they take your order. If they don't take your order, the kitchen never knows what you're ordering to eat. If they don't know what you're ordering to eat, the food is not going to be prepared. If you don't receive the food, you're not going to pay. So there's certain costs that are involved in running the business. And so these represent expenses. You have to spend this money. You have to outlay this money in order for the business to operate. So those are expenses. Cash just represents the money that you have in your bank account. In this case, your business bank account. Accounts receivable, very unique term. This is also considered to be an asset, primarily for stores like retailers or businesses like retailers. With a retailer, I may choose not to only take cash for purchases. I may decide to offer credit. So anytime I offer credit to a buyer, which means I give them the merchandise, but I don't collect immediately, I will collect the money over time, maybe in 30 days or 45 days. We call that accounts receivable. So again, you find that in most retail businesses. Inventory, accounts payable, long-term liabilities. Inventory, once again, we find this with retailers, not with service companies. I have to have something for the buyers to buy. We call it items available for sale. So inventory represents the cost of the items I purchased to make them available for sale to you, the buyer. Clothing, furniture, appliances, electronics, they're sitting on the shelf. You walk through the door, you're the buyer, you're ready to buy. So the items sitting on the shelf had to be paid for, and they represent the inventory available to the store. Accounts payable. This is a different form of liability. And what this means is that you owe money to a supplier. And that supplier is someone maybe you're buying paper from, pens from, let's say ink pens from, and they've given you credit. So that person could be Office Depot. You agree to pay them in 30 days. So that would be considered an accounts payable. So it's a debt that you have, but it's going to be paid well before the end of the year, something you have to pay in this time period within a year. Long-term liabilities. It's just the opposite of a payable. A payable is considered to be short-term. I will make the payment before the end of the year. Long-term means I have greater than 1 year to make the payment. That could be a mortgage, that can be a car loan, especially if I'm a catering company and I need a truck to carry my items around. I bought a new truck, so I'm going to have a car note. So those are going to be 3-year, 4-year, 5-year loans, so we consider those long-term liabilities. So, in summary, key assets found in most businesses are going to be tracked by your bookkeeper. And that's important for you. They're going to keep track of these assets. These assets are items that are ultimately going to help you generate goods and services for your customer. Not only the assets, but they're going to keep track, of course, of your expenses as well. So key assets that they're going to be tracking for you are going to be your cash balances in the bank. They're going to be capturing accounts receivable if you're a retailer, your inventory levels, your land costs, your furniture and fixture costs, your vehicle costs, equipment costs, and also how much you may have paid for buildings if you happen to have bought a building. So these are important items that you need to know about, an important category that you need to understand. And that is, again, the assets of the business are responsible for helping you sell or generate the goods and services that you provide to your buyers. Additional responsibilities of the bookkeeper. The bookkeeper is responsible to record all business transactions, classifying these transactions into one or more definitions for you. That's assets and liabilities. Typical transactions, again, are purchasing, inventory, buying supplies, hiring employees, and purchasing equipment. These transactions will vary based on the type of business that you operate. Whether you're a service business, a retailer, or manufacturing, all three business types have different activities that relate just to them. And as a business owner, you need to know that, especially if you're looking to start up a business. You need to know that there's different transactions for each business type, and you need to know what those transactions are, how to manage those transactions, and what your possible costs could be, or potential revenue you can generate from those particular activities. All right, let's just show you an example of what a simple transaction looks like, and also the accounting classification of that transaction. So I keep talking about the fact that accounting is set up to help you to track your business transactions. What is important here is to understand how accountants do it, and that's what this example will show you. So, general contractor completes carpentry job and receives $2,000 in cash. So I'm a general contractor, and for those of you who don't know, general contractors can have carpenters work for them, electricians work for them, plumbers work for them. They're the go-to person for people who have commercial jobs to do. So in this particular case, this general contractor did a carpentry job. Maybe they had to install a wall in a building. So they got paid $2,000 for that, and they got paid cash. So now what the accountant has to do is look at that transaction and decide how to classify it. So the company received $2,000 in cash, and this represents revenue received. How do we know this? The general contractor is a service company. They have carpenters, electricians, and, what do we say, plumbers who work for them. This was a carpentry job. So therefore, they were performing a service that they're comfortable in performing. Therefore, they earn the money by performing the job. So in this case, they earn dollars. Earned dollars are considered revenues. That's the first item that we classify. The second, the monies received are deposited into the bank. And this represents an increase in the cash budget or the cash account at the bank. So because cash is going up, we know that's the definition that's used in accounting. So cash in accounting represents the bank account. So now we know two items are going to be classified in this one transaction. One is going to be revenues. The $2,000 represents revenue, and the $2,000 represents cash going into the bank. So therefore, we flag it as cash as well. Now, there's additional steps that happen in accounting, but this particular presentation isn't for that. We're not here to teach accounting today. But what I want to talk about again is your bookkeeper is going to be capturing these transactions. And this is how they're going to think through them. They're going to look at the numbers, they're going to read the description of the transaction, and their job is to use accounting principles to classify those transactions for you in the appropriate account. All right, so that closes out this discussion around accounting and accounting principles as it relates to bookkeeping. Our next section, we're going to essentially introduce a business case so you can better understand how a bookkeeper can work with your business.